Hi everyone, JJ here. Welcome back. Well, today I'm going to react to this video with everybody's favorite permabull, Tom Lee. So let's get into it. He's talking about inflation today. Inflation is going to fall like a rock, he says. So let's see what his basis for this thesis is. Remember that Warren Buffett has said that predicting anything like this is just impossible. Many great investors have said this, but they do have him on these programs because he's willing to predict these things.
5,500 number, but it doesn't necessarily reflect how you think the year is going to end. Are you going to take a look at your year-end targets now?
We are, Carl. At the early December last year, we thought S&P could reach 5,200 this year, which at the time was almost a 20% gain. We've obviously moved well above it, and the fundamental picture to me looks stronger. I think earnings next year, we originally thought would be 260 for 2025. It's probably closer to 275. I think the war...
So he's always bullish on the index pretty much all the time. So he's upped his targets for the end of the year again because the share market is doing well, especially the NASDAQ index for sure.
On inflation has been meaningfully better in terms of progress. I know there was a lot of dispute, but I think the last two inflation reports and the fact that 55% of inflation components are back to pre-pandemic levels means inflation is really going to fall like a rock. These are factors that give us comfort that multiples can expand. And so I think 5,200 is clearly too low, but I don't know how much above 5,500 there is into year end. So I think in a couple weeks we'll be addressing that.
Okay, so he's saying inflation is going to drop like a rock, and that's going to be good for the stock market. And the S&P 500 is going to rocket. You know, he's making out like it's not a big target that he's got. It's definitely doing well. You know, one of the best probably years ever for the stock market, really so far. The best half years. We'll have to see how it goes over the second quarter. Of course, being pulled up by NVIDIA. I've made videos about NVIDIA. If you just go back the past few, there's a lot about NVIDIA, the talk of the day, the stock of the moment, really keeping on going. It dropped back a little bit, but still it's rocketing, and Tom Lee thinks that it's going to keep on going.
You actually use a graphic of a falling rock in your charts to describe elements of inflation that you think are dropping.
That's funny. This is the first time I've seen this, so I want to react to these. That's funny, a falling rock graph.
Said we're beginning to see insurances break, waiting for shelter to follow suit. Some of your forecast, Tom, on new cars and used cars, do you actually think we could see that kind of deflation?
Yes, I think you know, one thing to keep in mind is that there's almost 290 million cars on the road today. So when, you know, used car prices fall 10% and they're continuing to fall, that's a meaningful amount of disinflation and may be painful for people who've borrowed money to buy cars. But that is also, you know, saving people who are buying cars. And so I think there's a lot of goods disinflation in the pipeline. And especially with new cars, you know, inventories have really been picking up. The CDK cyber security hack might sort of disrupt it short term because there's a shortage now of new cars available, but I think the trend for new cars is also lower.
So disinflation and things like used cars or cars dropping in price, of course, that's probably not great news for Tesla and companies like that, which, you know, have had trouble with having to drop prices, well, you know, and to increase volumes, which hasn't really happened. So we'll have to see. But that's so inflation dropping, good for the market. Presumably interest rates also dropping. We went from the beginning of the year where it was 6 rate cuts expected from many pundits, and now we have, you know, one possibly by the end of the year in December or something like that is what the projection is from a lot of people.
So, Tom, what happens to earnings estimates in this environment? I mean, I get that it's good for the market if inflation falls and the Fed starts cutting rates. Maybe that trumps everything. But if the economy starts to really weaken and these forecasts for Q2 are coming down, then what about the earnings picture?
Well, it's, you know, first of all, there's always winners and losers. There's a lot of companies in sectors that have no correlation to inflation.
Micron, of course, coming out with earnings there just in the past day. It's down, as we on the screen there, minus 4.46, and that, you know, people are looking at that in terms of NVIDIA. It's a chip, but a memory chips. So, but they did have good earnings, but the stock fell because these stocks have gone up so much, I think, in the year to date so far. I'm not giving any recommendations on stocks, by the way. You got to take your own advice, get a licensed financial professional to help you with that, or do your own work. This is just for entertainment and general education purposes.
Technology is one example, and there's many groups highly correlated to the rate of inflation, like basic materials and energy. We're not talking about overall inflation going negative. It's actually that it's going towards 2%. So there's still plenty of companies that are getting price. And as you know, the biggest pressure on many companies' margins has been wage pressures. That's cooling a lot, and gasoline's cooling, and that's really helping consumer wallets. So I think it's pretty complex, but to us, if the global economy is picking up and earnings delivered have already suggested 270 for 2025, I still think we're maybe going to be closer to 280 next year.
Tom, if markets tend to lead the fundamentals and we've run up here, to let's say 21 times forward earnings, why would improved earnings relative to expectations now lead to multiple expansion, on top of what we've already had?
Yeah, multiples have expanded. The S&P 500 is pretty, in comparison to history. If you look at the Cape-Shiller ratio, it's pretty high compared to history.
It's a fair question. It's really the composition of what contributes to the gains, because if you look at S&P forward, it is high. I think forward earnings multiple is like 19, but the median is 16, and the median PE in the Russell 2000 is actually 11 times. So I think that there are going to be many stocks that can re-rate towards 20, but the PEs many stocks that are at 27 PE, I mean, they could increase in their multiple, but I think there'll be a lot more juice in the 16 multiple going to 20 than there is 27 going to 28.
Hey, finally, Tom, 5 days in a row, S&P headline index and breadth have diverged. We haven't seen that kind of streak since the late 90s. Are we going to start assembling lists of analogs to the late 90s, and is that a good thing?
Yeah, a lot of people are talking about, the late 1990s .com bubble with NVIDIA being stretched, a lot of these big cap techs being stretched, although also to the Nifty 50, which was an earlier bubble, which involved the biggest companies, the 50 kind of big companies where those got stretched, and that did come collapsing down. So maybe somewhere in between those two at the moment, because these are big companies that are roaring in terms of tech.
The late 90s didn't end well, so I think if this is going to look like the late 90s, then investors do have to be really preparing some portfolios that are appropriate for that, and that that in the 90s, late 90s, that meant to really be patient with value, and then of course be ready to.
Interesting that he says that, because he doesn't say that kind of thing very often. Permabull, as I say.
Exit the high momentum. In some ways, I think the skepticism that exists today, because I was an analyst starting in '93, so I saw the '90s. There was a lot more ebullience back then, and a lot more people who didn't think stocks could ever go down. I think there's a lot of top callers today. So for me, this feels a lot more mid-cycle. And I know it sounds surprising, but there's just too many top callers, especially.
That's actually what Howard Marks said over on the other channel, The Art of Value. I've done some videos looking at what Howard Marks, super investor Howard Marks, has been saying, and he thinks it's kind of moderate at the moment. He's taking the temperature of the market, and he thinks about market cycles. He thinks a similar thing.
Especially among our institutional clients.
Okay, so what do you think of that? Let me know in the comments if you agree with Tom Lee here. And on screen, I'm going to put a video to what YouTube thinks that you should watch next. So go and see that now if you want to. And also, I'm going to put a link to a subscription to the channel if you want to subscribe here. If you want to see more of this, do hit the notifications bell as well. And I'll see you in the next one. Thanks for watching.